feds are on a fucking spending spree. Hey folks, the government's Financial Consumer Agency of Canada came out with a report this month, and I'm telling you, the stats are really concerning. It's going to be a shit show. We're going to go through a scenario as well of what a renewal client is up against. We're going to take all your calls, your questions on episode 135 of the Wise Old Owl Show. Again, I'm Vince Gaetano. Thanks for joining me, and let's get right into it. 35.5% of Canadians hold a mortgage. A growing number of these folks are facing financial challenges. 2/3 of mortgage holders are having trouble meeting their financial commitments. 20% need to draw on their savings. 39.5% of homeowners increasingly need to borrow to meet their daily expenses. The stress level of mortgage holders is growing at a faster pace than we've ever seen. And folks, these stats are up until December 2022. Which means they don't even take into account the most recent rate hikes this year. So it's going to be a real challenge for folks to continue dealing with these high rates. A significant amount of people that have mortgages struggling to make their payments. This doesn't bode well. And this report that just came out, okay, this is a federal government report, takes into account stats up until December 2022. So this is a real challenge, and it's going to be a shit show. I'm just going to give you a scenario of what people are facing. So let's look at the vintage renewals from June of 2018. And to put things into perspective for folks, it was June 1st, 2018, when the stress test was implemented for conventional mortgages. So folks that had conventional mortgages with 20% down or more didn't have to deal with a stress test up until June 1st of 2018. Anybody who bought before that time or applied for a mortgage before June 1st never had to deal with a stress test, okay? So when you think of that, these are people that never really had to go through a stress test, and now it's impacting those that are shopping. So I'm going to give you an example. Okay, an individual that borrowed $750,000 in June of 2018, okay, would have had a payment in and around $3,071 on a 30-year amortization at an interest rate of 2.79%. They would be left with a mortgage, provided they just made regular payments, of $664,000. So fast forward to today. That individual, that couple, that family wants to shop their mortgage, okay? And they need a mortgage of $664,000 at today's interest rates. Today, they're looking at about 5.35%, which means they got to qualify at 7.35%. So back 5 years ago, they could get a mortgage for $750,000 with an household income of about $150,000. Today, they need over $200,000 in income, about $220,000, to qualify for $664,000. Their payment at $535,000 jumps to $39.95, almost $4,000, about a $900 increase, but they have to qualify at $4,795. So all of a sudden, these folks are like, well, hold on, how do I not even qualify for the mortgage I already have? And banks know this. And that's why these renewal letters that are going out to clients are not getting the best rates, okay? As I pointed out last week, these mortgage renewals from Schedule A banks are coming out at high 5% ranges, 6% ranges, not necessarily anything competitive. And that is because they know most likely you don't qualify, because chances are they know how much income is going into your bank account because you probably have your banking with them, and they have an idea of how much household income you have, and they know you can't shop. So you're kind of handcuffed and stuck with them. As we get into the second half of the year, where we're going to see more and more people coming up for renewal and seeing their payments shift upwards. Okay, these aren't folks that have variable rates. These are folks that have fixed rates at low rates in the high twos that are now going to be paying mid fives. Okay, and it's going to cause a problem. We're starting to see things break. And that's why I always say respect the lag. There is a lag period that takes place from when these rates go up to when things start to impact people's household debt. They're going into savings. They're scrimping by. Folks, you have to start taking an active measure into your budgeting. You got to start looking at your assets and liabilities. You got to look at what you could liquidate to get rid of your debt load, and do what you can to decrease unnecessary expenses. As I always say, get rid of the wants, focus on the needs, and hammer down the debt. When you don't owe as much as you previously did, your borrowing cost goes down. As everybody knows, I usually track how many used Porsches are for sale 100 kilometers away from where I sit at Dufferin and Orphis. I've been doing this since last September. When we started tracking this on Auto Trader, we sat at 944 used Porsches for sale. And this week, today, we're sitting at 1,166, significantly up from the 944, about 222 more Porsches for sale than there were back in September. But it's been flat a little bit week over week. Last week, we saw 1,168 for sale, so it's pretty flat right now. And usually this is a data point that I track just to see if there's more toys being sold as interest rates go up, as people's budgets start being constrained by the inflationary pressures. We start seeing toys being sold. And we figured, let's use a data point called Porsches for sale and determine that. So we're seeing that level elevated in the summer months, and it's been flat week over week. The 5-year bond, same thing, has been a little bit flat. Last week it sat at 369. It's sitting at 366 this afternoon. Not much activity, but there was that little bump last week after the Bank of Canada increased rates. And a month ago, we were sitting at 335. So we're up about 31 basis points, which is equivalent to that quarter point hike that took place. So it's built in, and we are seeing fixed rates move up. Some of the alternative lenders will be increasing rates as well. So they want that spread to deal with what could be coming. And chances are we could very well be seeing another rate increase on July 12th. But we're here to help you out. We're helping people every day budget. We're going through different tools. We're asking people to print their bank statements, print your credit card statements. Traditionally, people are online. They're only seeing 4 or 5 transactions at a time on their phone, not necessarily seeing the pages and pages of transactions that go through every month. When you print out those statements, and we usually ask for 6 months worth, you could really see what transactions we could get out of there. Start focusing on changing your habits, get rid of certain subscriptions, monthly obligations that you don't use. Chances are there's some in there. Let's get rid of them. Let's focus on eliminating costs. And this is a great time to reevaluate your mobile phone bills, your cable bills, anything that you're using on a regular basis to try to save a few dollars every month, which compounds to more money annually. We got a lot of questions. We're going to go into the hockey helmet. We're going to pull out a few. And I got a few email questions, and one I want to deal with as well, but we'll get to that in a sec. But the first question from Kazette 067. How can I pay down my mortgage faster? Well, every mortgage usually has prepayment options. Usually you're able to make a lump sum payment and then also increase your regular payments by 10, 15, maybe double them up. But you also have a lump sum component as well, which could run anywhere between 10 to 20, 25% per year, depending on the lender. Take advantage of these things. One of the things I always recommend to clients is give your mortgage a raise. Every year you probably get a raise at work. We strongly encourage folks to give your mortgage payment a raise. So if you do get a raise of 5, 10%, round up your payment to the next $50 or $100 to reflect that raise that you got, because any amount that you pay above and beyond your minimum payment obligation goes directly to principal. and that accelerates repayment and gets to zero quicker. So take advantage of those tools. Usually those lump sum payments are a big way to lower that balance. And when you borrow $400,000 or $500,000 and you're able to pay down anywhere from 10 to 20%, that's $50,000 to $100,000 on a $500,000 mortgage. So take advantage of that, because that all goes to principal and allows your regular payments to pay more principal after those lump sums are made. So take advantage of that. Let's go into another question. Arrigo 89. Are interest rates going down anytime soon? No. I'll leave it at that. We will be seeing higher rates for longer. And I want to bring up a point. I have been picking on Tiff Macklin over the course of the last year, but I really believe that Tiff Macklin and the Bank of Canada has been left to do the dirty work for this government. And it's unfortunate because back in, I think it was late 2021 or 22, the Bank of Canada mandate agreement was renewed by the finance minister, or part-time finance minister, Krista Freeland. And their mandate was to get to an inflation rate of 2%, okay? And the mandate and her note referenced that it was to be a joint responsibility by both the government and the Bank of Canada to achieve a 2% target rate for inflation. Unfortunately, TIF and the Bank of Canada have been left to do it on their own, because if it is a joint responsibility by both the federal government and the Bank of Canada, the Bank of Canada is doing it on its own, because the feds are on a fucking spending spree that's spurring inflation to the levels that is uncontrollable, okay? So it's very important that we hold this government to account and live up to the obligations that they set forth in this mandate letter. If it is going to be a joint responsibility, this government should ease up on the spending, which is causing significant stimulus, driving up inflation, and let's get rid of this fucking carbon tax. It's ridiculous. It's causing tremendous inflationary pressures and putting a hell of a lot of undue pressure on the Bank of Canada governor. So as much as I pick on him for being undecisive at times, he's really playing with both hands behind his back when you have a part-time finance minister who is just spending like crazy and making it very difficult to ease up on inflation. So, I need to throw that in there because it's causing quite a bit of frustration for many folks as they try to deal with inflation. And folks, I'm just trying to call it like it is. Robert 5110, do they take your equity into account on the stress test? No. That's a good question. One of the things that we find in dealing with the stress test is anybody who took out a mortgage pre-2018 or pre-June 2018, some lenders had equity programs. So if you had strong equity components to the deal, so if you had 35, 40% down, some lenders, if you had good credit, would grant you a mortgage. It doesn't happen anymore. The stress test is solely on a debt servicing perspective, which is income-based. And if you want equity type deals, you're really in the private space. Even the alternative lenders have very limited equity programs. There's still an income component. There has to be some validation of income stream. Not as intense as the A side, but rates are higher, a little bit more rigorous on the paperwork. But it is a little bit more difficult to get equity type deals in this marketplace. But thank you very much for that question. We did get a couple email questions. This one is from Gloria Yashuk. Actually, she sent it in today. She asks, Vince, I've been following you on Twitter and your podcast. Could you do a podcast on second mortgages and how they are a good way to protect an investment in divorce? There are a lot of boomers who help their kids with a down payment in the last few years. I'm sure they'd be interested in this information. Thanks, Gloria. Okay, so what she's referring to is these gifts. Okay, a lot of parents are granting gifts to their kids to buy their homes, and they want to protect their gift to their child if there is a divorce. And this comes up quite a bit. We talk about this, and we always encourage folks to speak to the lawyer to try to do something about it. Now, here's the issue. When you grant a gift to your child who's getting married, okay, it goes into the matrimonial home. And that matrimonial home is an asset of the couple. If, for some reason, this couple does get divorced, both parties split the equity in their home 50-50 because it is the matrimonial home. That's the law in Canada, okay? Now, in order to protect that gift, there has to be an understanding that that gift really isn't a gift, so to speak. So you have to speak to a lawyer to take advantage of registering a mortgage for the full amount of the gift that is repayable after the fact. And usually it wouldn't have any repayment terms other than it could be demanded at any time, okay? So what usually happens is these discussions should be had before the gift is granted, okay? And there should be an understanding, so that way you clear the air and you say, listen, I want to grant you a gift, but if something happens, I want to protect the interest for my child and not necessarily give up half of it. It's a tough situation. It's a very uncomfortable discussion at times, but the key is there should be an understanding, and you should speak to a lawyer to figure out how to navigate through that process. Now, there is a complication. When you're getting the mortgage financing, you are giving a gift. It's non-repayable. So somehow there has to be some type of understanding of how this gift is being accepted, and it does come with a condition, and that is if there is a matrimonial breakup, that a portion of this gift is repayable from the non-related party, but is related after marriage. So it's a little bit confusing, but I think that's what Gloria's trying to get to. And we deal with this all the time, but it is a little bit tricky. You need a lawyer involved, and you should make sure that everybody fully understands what the situation is. Again, want to thank everybody for coming out. I hit 1,000 subscribers on YouTube. I didn't think I'd be able to do it this quickly, but thank you to all of you who subscribed. If you want to visit the YouTube page, go to Owl Mortgage, hit subscribe, give me a like, put in a comment. I try to get to every question. And I really want to thank all of you for making that possible. I didn't think that there was that many folks that were eager to get more content, but thank you. I encourage people, if you have the resources to help out, there are many folks in need, and those that don't even have a house. We talk about mortgages, we talk about financing, we talk about shelter all the time here, but it's very important that we remember that there's also folks that don't have it at all. And if you have a chance, I really encourage you to visit the Instagram page for EHM. That's Edward Henry Mary 1913. It's Evangel Hall Mission. There's a link on their page where you can make a donation. If you could donate $5, $10, $25, it would be greatly appreciated. It's going to a good cause, and it goes directly to the shelter. Thank you to everyone again. Have a great weekend. Enjoy the weather, and we'll see you next week. Take care.